We like to think that governments and banks are unshakable, that the economies of entire nations can't crumble overnight. But history tells a different story. Sometimes even the most powerful empires, the richest kingdoms, and the most confident investors have discovered that money, no matter how abundant, can vanish in a blink. And few events illustrate this more than the financial collapse that forever changed Europe in the early 18th century. This is not just a story about numbers on a balance sheet, it's a story about ambition, illusion, and the difference between apparent wealth and true value. It's about how entire nations can be seduced by the promise of easy riches and then pay the price when reality catches up. To understand the collapse, we need to start in France under King Louis XIV. By the early 1700s, Versailles was the pinnacle of European luxury. Marble halls, golden decorations, sprawling gardens, the palace was a testament to opulence. Nobles competed to display their riches, importing silks from China, sugar from the colonies, and wines from Bordeaux. On the surface, France seemed unstoppable. Its culture, its art, its economy all dazzled the continent. But beneath the glittering surface, the system was hollow. The crown's debts were massive, and every lavish celebration, every grand military campaign only worsened the strain. Money was being spent, but value, real, enduring wealth, was being destroyed. Enter John Law, a Scottish financier who rose to power as France's Controller General of Finances. Law promised a solution: paper money backed by the Mississippi Company, a venture claiming enormous profits from Louisiana's lands. Initially, it seemed brilliant. Fortunes grew on paper faster than anyone had imagined. Investors, nobles, and speculators felt unstoppable, but the wealth was an illusion. The Mississippi Company's profits were exaggerated, its assets overvalued, and speculation ran wild. By 1720, confidence evaporated. Paper fortunes became worthless almost overnight. Those who had gambled everything on the promise of quick money were ruined. But those who held tangible assets, land, production facilities, skills, survived. This collapse wasn't just a financial event, it was a lesson in the fragile nature of perceived wealth. The pattern repeated itself across Europe. Nations, investors, and even common citizens repeatedly fell for schemes that promised extraordinary returns. Wealth, when divorced from real value, was like a castle built on sand. And yet, the lure of fast riches never disappeared. Take, for instance, the economic conditions in the Netherlands during the same period. The Dutch had built a robust trade and banking system, accumulating real value through shipping, commerce, and control over essential goods. While other nations were dazzled by paper schemes, the Dutch had infrastructure and productive assets that allowed them to weather storms others could not. This contrast highlights the lesson. True resilience is built on enduring value, not flashy numbers. Fast forward a century, and the same lesson reappears in the European banking crises of the 19th century. The Napoleonic Wars had left many nations deeply indebted, forcing governments to borrow heavily from private banks to fund military campaigns, infrastructure projects, and post-war reconstruction. Banks, flush with optimism and eager to lend, sometimes extended far more credit than the economy could support. When a few key borrowers defaulted, panic spread quickly through financial hubs like London, Paris, and Amsterdam. Investors who trusted paper claims without examining the assets backing them found themselves facing devastating losses almost overnight. Yet, amid the turmoil, a pattern emerged. Those whose wealth was tied to tangible, productive assets survived far better. Merchants dealing in essential goods, landowners, skilled tradespeople, and producers of vital commodities maintained their purchasing power even as paper fortunes evaporated. The fundamental truth remained unchanged. Money is a claim on value, not value itself. Without understanding the foundation behind financial instruments, even seemingly secure holdings can become fragile. This lesson resurfaced in the early 20th century with the hyperinflation of the Weimar Republic in Germany. After World War I, the government faced enormous reparations obligations. To meet these demands and finance domestic spending, authorities resorted to printing massive amounts of currency. Initially, the policy masked financial strain, but soon the effect was catastrophic. Prices doubled, tripled, and then escalated by the hour. Life savings became worthless, and families were forced to transport banknotes in wheelbarrows just to buy basic food. The currency, once a symbol of national stability, had lost nearly all practical value. Once again, those who possessed real, tangible assets, land, machinery, or skills that could generate goods and income were able to endure the crisis. The lesson was consistent across centuries. Financial instruments and paper wealth are only as secure as the underlying economic value that support them. Systems can fail, governments can mismanage debt, and crises can strike suddenly. But productive assets, skills, and essential commodities provide resilience that no amount of paper money alone can guarantee. History shows that understanding the true nature of value is the most reliable defense against financial collapse. Now, here's a question for you. Wherever you're watching from, do you feel your savings, your investments, or even your job security could withstand a similar shock today? Because the truth is, history doesn't just stay in the past. It repeats in patterns, dressed in modern clothing. Banks fail, markets crash, currencies fluctuate, but the principle remains. Value endures where illusion fails. So, consider the lessons from France, the Netherlands, and Germany together. They tell a consistent story. Financial collapse is rarely about randomness. It is about overconfidence, misallocation, and a failure to distinguish between wealth on paper and true value. Those who survive and even thrive are those who recognize that money is not the ultimate measure of security. Security comes from what you can produce, trade, or leverage in real-world terms. Owning productive land, learning trades that people will always need, or investing in essential resources ensures you are not entirely dependent on paper wealth. Diversifying across these forms of value builds resilience. The second step is mindset. Don't measure success by numbers on a statement or the size of a portfolio alone. Look deeper. Ask what backs your wealth. Ask whether it could survive the Mississippi bubble, the Napoleonic bank defaults, or hyperinflation in Germany. If the answer is unclear, you have work to do. The financial collapse that changed Europe forever wasn't just a moment in history, it was a mirror. It shows what happens when ambition, speculation, and greed overtake prudence and reality. But it also provides guidance. True financial security isn't about chasing the highest number. It's about building value that endures, producing something essential, and holding assets that cannot be arbitrarily destroyed by policies, crashes, or speculative manias. History gives us the insight to act before disaster strikes. The French nobles lost fortunes, German citizens lost life savings, and countless investors across Europe learned the same brutal lesson. Numbers lie, but value doesn't.